Hello friends, good morning to all of you. And in the last session related to bank financial management, in this series, we covered a many important topics related to the credit risk, and we ended the particular video with Altman Z score and credit risk plus and credit service. So if you have particularly watched that video, just do watch this video particular right then. And because that video is right now available on our YouTube channel, but will be removed very shortly, will be available for members only within a very shorter duration. And also we are conducting BFM series in which we are going to cover very important topics for the BFM module B and module A that actually weighs around 60% of the total marks in the exam out there. So kindly do confirm the audio video quality at the earliest, and further, if you have not subscribed to our channel yet, do subscribe to the channel at the earliest and press the bell notification icon so that you get updated whensoever we upload the new videos. I'm Ashish Jain and I basically bring the daily latest content related to JIB, CIB bank promotions and certification exams. Kindly do confirm the audio video quality so that we can proceed with today's video. And this is the part 6 where we'll be covering the topics related to the operational risk management as well as related to the uh, credit risk. So let's now start the session over here, and it's related to the credit risk. We basically enter with the last topic. It's actually related to the management framework for the credit risk over here. So if we talk about the Altman Z score that we basically ended the video with, what was the criteria? The criteria was somewhat like over here. So we calculated the Z score, and if the value of the Z score lies between the 0 to 1.8, if the value of the Z score lies between 0 to 1.8, then definitely there will be bankruptcy as per that particular condition. And if the value is between 1.8 to 3, if the value of the Z score is between 0 to 1.8 to 3 over there, in that scenario it is under the gray area, and further there may be future bankruptcy but not surety about the same. But if it is greater than 3, if it is greater than 3, in that case there will be no bankruptcy at all. Right, is that clear? So now let's further move toward the next topic related to the credit risk, and that is actually the management framework. That what is the management framework related to it? So we actually covered the criterias for the credit risk related to the identification of the same, that how we do identify the credit risk over there, how we basically go for the measurement of the same, that is a quantification component, and also we looked into the different things. And now it's related to the management framework. Third point, it's actually the control and monitoring. That what do you mean by the control and monitoring related to it? So let's have a look at it. So let's have a look at it. So we should be looking for, the credit risk at every huge point or every single point in the banking industry, because it is a widespread risk. So credit risk is not something like which is not present everywhere. It is a risk which is present everywhere because it is widespread, and further there is a very high degree of the credit risk everywhere in the banking industry, because lending is the main component of the same, right? And further it is a core risk the bank basically plays with, we can say, right? And further we should be learning about one more concept over here, that's actually the active portfolio management. Now what do you mean by the active portfolio management? The active portfolio management is something like that we should be looking at the dynamics of the economy. Let's say when we are managing our portfolios, let's say this is our portfolio and we are going to manage our portfolio, we should be actively managing the particular portfolio, looking at the live market conditions, looking at the live market conditions. That is particularly said to be what, that is the active portfolio management. And further we should be looking the credit risk policies at the transactional levels, that we, when we are sanctioning single loan out there. And also we should be looking at the policies and the guidelines which are to be followed at the portfolio level. That is, we are talking about the all the loans altogether, because there is netting of the particular risks also. Let's say case some kind of credit risks are present at the individual level, some kind of the risks are present at the individual level, that is at the transactional level, and for the some kind of risks are present at the portfolio level. Portfolio, when we are talking about a bunch of loans, we're talking about the complete loan set out there, that is a portfolio level over there, right? So let's have a look at it. So if we talk about the transactional level, so if we talk about the transactional level, we should be looking for what? We should be looking for the different standards. We should be looking for different standards. That's actually, first of all, it's related to the delegation of powers. First one, it's actually related to the delegation of powers. Now, what do you mean by delegation of powers? So the bank must be having proper policy for the same, that how the power will be delegated, how the power will be delegated to the different staff officers and different personnel out there who will be basically approving the loan. So there should be multi-tier system, that how the loan is to be approved. That's the first case. We are talking about the transactional level right now, right? So the first thing, it's related to setting up the guidelines, related to setting, bank must be having the policy related to the delegation of powers. And further, the other one, it's related to, there should be a committee for the same. There should be a committee for the same. A committee must be formed, and committee must be comprising the functional heads from the different things, or it may be having 3 to 4 officers which will be approving the credit facilities over and above a specified limit. Let's say case the bank has set up the credit committee, and further they say that any loan which is beyond rupees 10 lakh is to be having a soft approval by the credit committee. So whatsoever the loan is there which is basically beyond the component level of rupees 10 lakh, it is to be approved by that particular credit committee beforehand. That is particularly what that should be. And one officer in this particular committee must be from the CRMD. One particular officer from the CRMD, that is Credit Risk Management Department, must be there. Must be there. He must be representing in this particular committee over there. Is that clear? Is this particular point clear to you? Right. So that is actually related to the delegation of powers. The second component over here related to standard and guidelines, that's actually related to credit appraisals. That's actually related to credit appraisal, that how the loan will be sanctioned, what standards will be followed. So borrower standards must be followed, and further related to the processes and procedures, that how the credit requirement and risk factors are to be analyzed. That's actually under the credit appraisal, that how you're going to appraise this particular loan. Let's say case person A visited the bank branch, and further he said that he wants a loan of rupees 25 lakh. How you are going to analyze that particular thing? What is the criteria? What is the process? What is the standard process and procedures? How you're basically calculating the risk factor associated with this particular loan facilities to be sanctioned? Those all things must be kept in mind, right? That's a particular thing. And after that, it's related to the rating, that first of all we were talking about the first of all we should be having the prudential limits also. It's also about the prudential limits, but before that, let's talk about the rating standards and the benchmarks. So the transactional level, the third thing, it should be related to the rating standards and benchmarks, that credit risk assessment credit risk assessment must be delinked invariably from the regular renewal access. It should not be like that, that if you're doing the regular renewal, like you're particularly reviewing the loan and further renewing the particular process over there, you should be updating the credit rating. Let's say case a person took loan 1 year earlier, and further now you want to renew the loan, you should be looking into the updated particular credit rating of that particular borrower, so that the borrower is still eligible for the loan to be sanctioned or not, right? That should be looked into. And after that, it's actually related to the risk pricing. It's related to the risk pricing, or we can say simply the pricing strategy, or we can say pricing strategy. So the banks must be moving toward what approach? We have been learning about this particular approach from the very first video related to the risk management. So it's a RAROC. The bank must be moving toward the RAROC, that is a risk adjusted return on capital. And further, you should be looking what is the expected loss in that particular factor. You should be looking into the different factors, that what risk is associated, and accordingly you should be charging the borrower, and so that the bank is profitable and also covering the risks at the same time, that must be looked into, right? So that's the main part. So you should be comparing the prices which are quoted by the competitors and also by any other entity out there, and you should also be looking into different risk factors which are being particularly taken by the bank out there, and accordingly you should be charging the customer out there, right? So that's the main thing that's actually related to risk pricing over there. One more thing is actually there, that's actually the I can be mentioning it over here. The point is actually related to prudential limits. It's related to the prudential limits. Now, what do you mean by prudential limits? So the bank must be following these particular limits, which are actually set up so as to limit the credit risk. These prudential limits can be helping a lot so as to limit the credit risk at the transactional level, at the individual level. Now, the transactional limit, it could be related to the credit exposure, it could be related to asset concentration in one particular category. Let's say case you are going to sanction a loan, right? So you should be looking for what maximum credit exposure can be advanced to single counterparty, right? The limits are being given by the Reserve Bank of India, and the bank is to sanction the loan keeping in mind those particular credit exposure limits. And also there should not be any more larger exposure. There is also a limit for the same. The board policy must be ascertaining some case of those particular larger exposures also. And also the sanctioning authority should be looking into the maturity profile of the loan book over there, right? So that must also be looked into so that the asset liability management can be managed. And further, it's related to the different limits. So what are the different limits which are to be followed? So whether it's related to, let me just write the different kind of limits over there. So whether it's related to the credit exposure, let me just write and mention. So whether it's related to credit exposure, or it's related to your checking the asset concentration. Let's say that your branch has been sanctioning a lot of MSME loans, right? And further, you shouldn't be sanctioning then much more loans about the MSME out there, because if there will be a downturn in the MSME sector, then definitely your branch will be facing a huge risk out there, right? So you must be looking into the different factors. You should also be considering the asset concentration, and also you should be looking to the overall limit of the large exposures out there. So all those things must be looked into, right? So that's the case. So that is a case related to it. I hope that you must have understood the case related to it, right? And further, the last but not the least, actually it's related to loan review mechanism, that how we are actually reviewing the loans, right, at individual level. That's a loan review mechanism. Every loan must be reviewed, must be followed. There must be a proper follow-up over there, so that we can limit the credit risk at the individual level, right? And further, after that, it's related to controlling and monitoring, but it's related to portfolio level. It's related to portfolio level. Portfolio level means what? When we are taking all the loans together, let's say we are not looking for the single loan, but we are looking for the multiple set of loans out there. That's a portfolio, right? So we should be looking the identification. First of all, we should be identifying the risks which are there in case of the portfolio, and after that, it's related to, we should be looking for the credit weaknesses in that particular portfolio out there. And further, we should be looking for the quantitative ceilings, right? Quantitative ceiling means what? The number wise particular representatives, right? The figures, different figures we should be looking into, that particular limits are being breached or not. That must be looked into. And further, we should be having a rating wise distribution. We should be having a rating wise distribution, right? So that should also be done at the portfolio level. Let's say how many A plus category borrowers are there, or triple A category borrowers are there, or particularly we can say triple B category borrowers are there. So that particular rating wise bifurcation should be there, so that you can be having a look at the portfolio level, that how your portfolio is behaving. We should be looking for the default tendencies out there. We should be actually be monitoring the particular portfolio industry wise and sector wise. We should be looking for the entry level criteria, that what is the minimum entry level criteria, and further how we can insulate the particular portfolio from further deterioration. If we are basically want to, let's say case, we are sanctioning loans to particular civil reports which are having 500 as the average credit rating, right? And further, we are having a very bad let's say portfolio right now. So if you basically want to improve the portfolio structure, we should be considering to uplift that particular credit rating, so that the minimum entry level criteria is basically changed over there. And further, we should be introducing the discriminatory time schedule for review of the borrowers also, right? So these all things can be done. These all things can be done at particularly the portfolio level over there. So these all can be done at the portfolio level over there. Now we should be controlling the credit risk through the loan review mechanism also. Now LRM is very much important to understand. LRM is what? LRM is loan review mechanism. It is loan review mechanism. It is actually a tool. It is actually a tool, so which is actually used so as to evaluate the quality of the loan book. Okay, and the main objectives of LRM are actually related to what? It is actually related to we should be identifying those particular loans which are having developed the credit weaknesses, and further the timely corrective action should be taken. So we need to identify. So LRM helps in what? Let me just write over here. So if you're talking about the LRM helps us to identify the credit weaknesses, right? Which basically need steps to be taken so that we can be taking the corrective actions. That's the first case over there. And also to evaluate the portfolio quality, we can be looking at the portfolio quality, that what is the quality of our portfolio level over there, right? So that's a portfolio quality factor out there. And the third one, it's related to, it can be providing us with the information related to determining the adequacy for the loan provision. Let's say case, if the loan is a deteriorating loan, so whether the particular provision is being maintained so as to cover the losses. So it basically let us know about the provisions to be maintained, right? We can be checking the adequacy of the provisions. And also it helps us that whether we are following the policies or not. So whether we are being following the policies or guidelines related to the sanctioning of the loans out there, related to monitoring of the loans out there, so whether relevant laws are being covered out there or not. And further, it also provides information to the top management. So it also give the insights to the top management. It also give the information to the top management related to the credit administration. So those all things are being done in case of the LRM, that is a loan review mechanism. So it basically helps in risk evaluation, and also related to the sanctioning process, and also related to the post sanction follow. It helps us a lot in all the manners out there, right? So that is a main benefit of the LRM, that is a loan review mechanism. I hope that these all points are clear to you. I hope that these all points are clear to you related to the LRM there, right? And the second thing that we can be following at the particular portfolio level for the mitigation of the risk of the credit risk, that's a credit risk mitigation. That's a credit risk mitigation. Now, credit risk mitigation is actually related to what? That you want to reduce the risk. That definitely mitigation means what? That we want to reduce the risk, and further the risk is reduced eitherly, or it is actually transferred to the counterparty, right? Some other counterparty. So either it is going to be reduced, we are going to reduce that particular counter risk, or we are basically going to transfer the risk, transfer the risk to some counterparty out there. That is what? That is a credit risk mitigation. Now let's learn about the different risk mitigation techniques over there. Now in that particular scenario, in case of the credit risk mitigation, we are going to use the credit derivatives. Now derivatives are basically having no value of their own. They basically derive their value from the underlying asset out there, and using the different kind of derivatives like CDS, that is a credit default swap, or TRS, total return swap, or crediting notes out there, or credit linked obligations out there. So we can actually be reducing our risk and further transfer the risk from ourselves, from our particular, let's say, book, to the other counterparty, right? That how synthetically we do create the risk on other parties, or we basically buy protection from other parties out there. That's a usage of the credit derivatives. That's a usage of the credit derivative. So let's now learn about the credit derivative first of all. Now what is a mechanism of credit derivative? Let's have a look at it. What is a mechanism called a mechanism of credit derivative? So now let's take the case that we are having a bank here. We are having a bank here which has actually sanctioned a loan to the party ABC. It's a corporate, right? it's a ABC corporate to whom a loan has been sanctioned, and let's say this loan is amounting rupees 10 crore, and the bank is worried about if this there will be a default in this particular loan, if there will be a default in this particular loan in different credit events. Now, as per the ISDA, that is International Swaps and Derivative Association, that is said to be ISDA. As per the ISDA, there are six credit events. It could be related to the bankruptcy. It could be related to the obligation and acceleration. It could be related to obligationary default. It could be related to failure to pay the amounts out there, that whatsoever the let's say installment is there, the borrower is not able to pay, and it could be related to the moratorium, or it could be related to restructuring, right? So these six events have been defined by the ISDA. So if any of the event will be there in that scenario, the protection seller is to compensate. The protection seller is to be compensated. So we were talking about the bank who wants to buy the protection, so it is said to be the protection buyer. So it is said to be the protection buyer out there, right? Is it clear? And further, now the bank actually connected with the other protection seller. Let's say we are having the protection seller over here who is going to sell the protection, or who is a risk buyer, or we can simply say the protection seller is what? It is a risk buyer. That is a definition more appropriately. So the bank will be paying a particular premium. The bank will be paying a premium amount to the risk buyer or the protection seller. And if there occurs any kind of event as defined by the ISDA, in that scenario, the protection seller will be compensating the bank there, right? So that's a basic functioning of the derivative. So there's a basic functioning of the derivative, and we basically explained the CDS, that is a credit default swap in this particular scenario, right? So that's the case related to it. Is that clear to you? Kindly please do confirm if this particular definition is clear to you or not, related to credit derivative, that how those work, right? Now let's learn about the credit default swap first of all. Let's learn about the credit default swap first of all, and we will be learning about these particular credit derivatives. So first one, it's related to credit default swap. The other one, it's related to credit linked notes, and further it's related to TRS and credit separate options and securitization. So now let's learn about the credit default swap for the first instance, right? So now let's have a look at this particular blackboard with us. Let me just look for a, okay, so we are having the particular space over here. Now let's learn about the CDS, that is a credit default swap. Is that clear? So I just told you the idea related to it. Let's learn it once again. So here we are having a particular security or particular loan account where there is a probability of default. The bank is worried about. The bank has sanctioned a loan. Let's say ABC Bank is there, and bank has sanctioned a loan to this particular party out there. And further, in the case of event as mentioned by ISDA, there are six events, right? So if any of these six events did happen, in that scenario, the bank who is protection buyer, that particularly is paying a premium to the protection seller. The protection seller will be compensating for the same. That's actually the CDS, that is a credit default swap, right? So credit default swap in simple words we can say is a transaction where a protection buyer or credit hedger, we say credit hedger to be a protection buyer, that is going to pay a periodic premium. So periodic premium is being paid to the protection seller out there, and further, in case a credit event does happen, that is to be compensated by the protection seller, right? And the settlement can be of two types. It could be a cash settlement. Now let's say the default was there, let's say the loan was not paid and default was there, and ABC Bank seeked for the assistance. In that scenario, the protection seller is going to compensate the protection buyer. Now ABC Bank is a protection buyer, and further here we are having the protection seller. Now protection seller is going to compensate. There are two ways the protection seller can compensate. One way, it's actually related to, there can be the physical settlement, there can be physical settlement, or it could be related to that there can be the cash settlement out there. Now cash, particularly in case of physical settlement, which is very much common, the protection buyer is going to hand over, or it's going to assign, or it's going to sell the reference obligation to the protection seller in basically receiving the notional amount of the swap out there. Let's say case there was default of rupees 10 lakh. There was a default of rupees 10 lakh. In that case, the total loan was amounting to rupees, let's say 10 crore, and the default was amounting to rupees 10 lakh. Now the protection buyer is going to sell this particular obligation to the protection seller. Protection seller is going to pay rupees 10 lakh only, and not the whole amount, right? Now see, not the whole amount. Rupees 10 crore won't be paid, only the notional amount, the particular default amount will be paid. That's actually what, that's a physical settlement, right? In that particular scenario, the notional amount of the swap is just paid, right? And further, it could also be the case related to cash settlement. In case of cash settlement, actually what happens, they appoint a calculating agent, or we simply say a calculation agent will be appointed in case of the particularly cash settlement, which will be determining the post default cash value of the reference obligation. Now the calculating agent will be defining what, it will be calculating the values related to post default value of this particular reference obligation, and the complete amount is to be paid by the protection seller to the protection buyer out there, right? That's the main case related to it, that the par value, and further this particular price which the calculating agent has calculated, the whole value is to be paid. That is to be done in case of the cash settlement out there. Is it clear? But which one is more preferable? The physical settlement is much more preferable, right? After that, it's actually related to the second one that we need to we are going to basically discuss over here. It's actually the credit linked notes. It's related to credit linked notes. Now see, in case of the previous one, that is in case of the credit default swap, what type of exposure was there? In case of CDS, what exposure was there? There was off balance sheet exposure. There was off balance sheet exposure. If we talk about the protection seller, what kind of exposure was there? Off balance sheet exposure was there, right? But in case of credit linked notes is actually equivalent to the CDS. It is actually equivalent to CDS, but in this case, on balance sheet exposure is created. There is on balance sheet exposure, right? So CLNs are balance sheet equivalents, on balance sheet equivalents of the CDS out there. So basically, credit derivative to normal bond instruments, these are being calculated and converted into, and further that's the main thing related to CLN, that is a credit linked notes. Now let's learn more about the credit linked notes out there. So in that particular scenario, the credit derivative which is an OTC component, that is a over the counter component. Why we say the over the counter derivative out there? Because whenever we're talking about the derivative, whensoever we talk about the derivatives, there are two type of the derivatives. One, it's related to the OTC, that is over the counter traded, and further it's related to exchange traded derivatives. Now those particular derivatives which are framed, which guidelines are framed between the two individuals or two parties out there, that is particularly the OTC, that is the over the counter. It can be tailored as per the specific needs of the counterparties, right? And further, if it is exchange traded, in that scenario, there are standard terms and conditions. There are standard terms and conditions, like in the case of futures. In case of futures, these are basically standard traded, right? And further, if we talk about the OTC, let's CDS is what? CDS is OTC contract. Why we are saying OTC contract? Because two parties, that's protection buyer and protection seller, are basically having a deal in between them, right? So it's a OTC, that's over the counter derivative, right? So that's the case. Now, but in the case of this particular case, that credit derivatives are converted into standard capital instrument, standard capital market instrument out there. That's a credit derivative. That's a credit derivative. Now let's understand the working of the credit CLN, right? How the CLN does work, right? So first of all, as we have discussed, that the protection buyer will be there. Protection buyer will be there. That is the risk seller. We also say it to be the risk seller who is going to sell the risk. And further, there will be some originator, particularly we can say the reference entity, not the originator. We can be saying it's there will be a reference entity. in whose concern the particular credit linked notes are to be sanctioned, right? So we are having the reference entity to whom the loan has been sanctioned. We can simply say the loan is sanctioned, and the reference entity is to pay the principal plus interest to the protection buyer, right? So that's the case. And further, and also it's related to protection buyer is going to pay some premium, or we can say coupon payment, to the protection seller. It must be paying some coupon. We say basically not premium in this scenario, we say it to be coupon. So this particular coupon is to be paid to the protection seller. In case of CLN, we name it the particular coupon, right? And further, whatsoever amount is being recovered, so whatsoever the amount is being recovered by the protection buyer from this reference entity, that will actually be paid to the CLN, that will also be paid to the particular protection seller over there. So whatsoever the recovery is being generated from this particular loan, that is to be paid to the protection seller over there, right? In case of credit event. Now, why I'm saying so? Because what will happen in the case of the credit event? Now, the six scenarios I told you, those have been given by ISDA. Now, in case of that particular case, the protection seller is going to issue the bonds, right? And these will be named as what? These will be named as the CLN, that is a credit link notes. Why we are saying them credit link notes? Because these bonds have been issued by keeping the reference entity as a security, by keeping the loan amount as a security. So these bonds will be issued, and the buyers will be there, they will be investing into these CLNs, right? And further, the amount will be given to whom? By the protection seller. The amount will be given to the protection buyer. In the case of the credit event, the amount will be given to that. And whatsoever the recovery that is particularly being generated from this particular reference entity, that will be transferred by the protection buyer to the protection seller, and by protection seller to the credit link note buyers. Is that clear? So this is the component related. Now in this particular scenario, an on balance sheet exposure is being created, right? And further, the risk by way of the CLN, by the way of credit linked notes, is transferred to a huge market of the buyers out there. Now the risk is not only with the protection seller, but it is distributed to much broader market of the investors out there. Is that clear? So this is actually the working related to the credit linked notes. This is the working related to credit notes, right? So there are three parties. One is related to protection buyer, the protection seller, and the reference entity. And in case the credit event happens, in that scenario, the protection seller is actually going to issue the credit linked notes based upon that particular reference entity. And further, the buyers will be investing in that particular credit linked notes. And further, the amount is to be transferred to the protection buyer. And ultimately, whatsoever the return is being generated, that will be transferred to the credit link note buyers out there. So that's the scenario related to it, right? So the protection buyer will be getting the money in case of the credit event, and further the risk is transferred to a huge number of buyers when they have particularly invested into the credit link notes, right? So that is a credit link notes. That's why we are saying it will be the on balance sheet equivalent. We are saying it will be the on balance sheet equivalent of the CDS, right? In case of CDS, the off balance sheet exposure was there, but in case of CNN, on balance sheet exposure is there. Okay. After that, we are going to cover about the next one. That's actually is a TRS. That is a total return swap. Total return swap, right? That is particularly the TRS out there. Right. In case of the CLN, if we talk about the CLN, we basically keep an exposure on the value. We basically keep an exposure on the value. In the case of the credit link notes, an exposure, a particular, let's say, was covered. What's the kind of exposure was being covered? The value exposure. Whatsoever the default is there, that value was being covered. But if there is any market economic impact on that particular value, on that particular reference entity, that is actually not covered in case of the total return swap. What I mean by the economical value? let's say if there is any change in the market value of that particular reference entity due to the adverse conditions, or let's say due to the adverse changes in the interest rate over there, those are not being covered. So if there is any market change, those are not being covered in case of the credit linked notes or any other criterias, but that exposure can be created and can be covered in case of the total return swap. That can be covered in the case of the total return swap. So in this particular scenario, in the case of the total return swap, the protection buyer is going to swap with the protection seller the total actual return on the asset. So whatsoever the actual return that the protection buyer was getting, the protection buyer is actually going to get all that particular return in exchange of the premium, right? So even if there is some economical adversibility in the particular reference entity, that will also be covered in case of the total return swap. So protection buyer is going to pay a premium to the protection seller. It is going to pay a premium to the protection seller. And here we are having the some underlying asset over there. Here we are having the underlying asset, and if there is any kind of deterioration, that will automatically be covered. And for the protection seller is to pay a particular return. The protection seller is going to pay a particular return, and a synthetic return is particularly being received by the protection seller. Whichever the return is being coming from the underlying asset, that will be that will be received by the protection seller out there, and the protection buyer will be receiving the return from the protection seller. That will be a fixed return, right? So synthetic particular exposure is being created. Synthetic exposure is being created. So we can simply be saying that the protection seller will be paying the return of what? It will be paying the return. The return will be basically having a quantum of what? It will be quantum of LIBOR, that is London Interbank Offer Rate, plus let's say whatsoever the spread is being decided, plus whatsoever the depreciation that is being decided. So that will be paid by the protection seller to the protection buyer, and for the protection buyer is basically paying a premium to the protection seller, and also whatsoever the return from the underlying asset out there, that will be paid to the protection seller, right? So in that scenario, the protection buyer is actually receiving a fixed stream of income. It's receiving a fixed stream of income, and if there is any up and down in the incomes or in the particular recoveries from the underlying asset, that is to be borne by the protection seller. That is to be borne by the protection seller, right? So total return swap is actually representing an off balance sheet exposure replication on the financial asset. So these was the financial asset. So here we are having this one as a particular asset over there, but the exposure was created in the books of the protection seller. So even the protection seller, if has not lent to this particular underlying asset, the exposure has been created in the same way if it would have lent to the same party out there. That is why we say it to be the total return swap, because we are not only covering the credit events, but also if there is any economic downturn due to the adverse movements, if there is any economic downturn and further you're not receiving that much return on that particular instrument out there, now that will also be covered in the scenarios. That's why we say the condition to be total return swap. Is that clear? Is this particular point clear to you guys? Okay, now let's move toward the another one. It's actually related to the credit spread options. It's related to the CSO, that is a credit spread options. Now what do you mean by credit spread options? Now basically enable the credit hedger. Credit hedger means the protection buyer. So credit spread option basically protect the protection buyers, that's the risk sellers, so as to protect themselves from unfavorable migration or credit spread risk of an asset over there. What does it indicate? Let's say case previously you were having a loan with you, and the further the individual party or the loan was rated to be triple A category, but now it downgraded to double B category or B category out there, right? B rating category out there. So that is what? That is a credit risk migration or unfavorable migration, we say, right? Or we can simply be saying it to be the credit spread risk of an asset. We can simply be saying the credit spread risk of an asset out there, right? Now those all risks will be covered in case of the CSO, that is a credit spread options. Those will be covered in case of the credit spread options right there. Is it clear? So periodic stream of payment, that is a particular premium is to be paid by the protection buyer to the protection seller. That is to be paid by the protection buyer to the protection seller. And further, if there is any kind of migration between the particular, let's say, if the rating is reduced or downgraded, that will be covered by the protection seller to the protection buyer out there. That will be compensated. That will be compensated, right? And for the credit spread options, because it's an option, so these can be exercisable in the American style option or in the European style option. So it can be executable in the American style options, that is on the date of maturity or before the date of maturity they can be exercised. Now let's say case, uh, PB, that is a protection buyer, want to sell before the maturity date or on the maturity date, then it will be American option style. And further, if it is only meant for the maturity date only, that on a particular date only, if it can be exercised, then that will be said to be the European style option. Then it will be said to be the European style option, right? So that's the case related to credit spread options. Now let's move further and further. Let's learn the concept related to the securitization. Let's learn the concept related to the securitization. Okay, so we have covered so far so many things. Now let's learn about the securitization. Okay, so let's say case that we are having an originator over here. We are having a originator, we are having a bank which has actually sanctioned loans, and this is a pool of loans. This is a pool of loans, and these all loans are non-performing asset. These all loans are non-performing asset, and the bank is not able to generate any kind of income stream for the same. Okay, so the bank is not able to generate any kind of income stream from the same. Now in that scenario, the bank can be selling all these NPs. Let's say these are asset backed securities. These are asset backed securities. Let's say these are the cases of the home loans, and these are asset backed securities, and a charge has been created on their properties, right? A mortgage charge has been created on the properties in these scenarios. Now the bank can be selling these loans. Bank can be selling these loans to a company called ARC, that is a asset reconstruction company. So the loans are to be sold by the bank to the ARC. ARC will be purchasing the these particular loans over there, and for the ARC will be setting up, the ARC will be setting up asset SPV, that is a special purpose vehicle. Now SPV will be managing these assets. Whatsoever the NPAs are over here are to be managed by the SPV, and further it will be trying to recover the amounts in these particular NPAs, and further it will also be issuing the SRs, that is the security receipts, based upon these exposures. Now these NPs are there, and these are the asset backed securities. These are the asset backed securities, and based upon these NPAs, the SPV is going to issue what? It is going to issue the SRs, that is the security receipts. And further, the QIBs are going to invest in these particular SRs, right? So the investors are going to invest in these SRs, that is the security receipts, and further they will be investing money. There will be money with the SPV, that is with the ARC. ARC will be paying the liquidity to the bank. Now the bank whose liquidity was not there, now these particular banks will be having the liquidity again, because they have cleared off the NPAs from their balance sheet. Now they are not to maintain the capital for these NPAs, because let me just tell you, for the NPAs you are to maintain the provisions, you are to maintain the capital in your balance sheet. Now when you have basically sold these NPA to the ARC, you're not to maintain the capital, so the bank is freed from that particular charge, and also the bank will be receiving the liquidity. And the what is the benefit to the ARC? That ARC will be trying to basically have the recovery in these loans, and ultimately whatsoever the recovery in these loans, that will be paid to the investors. That is will be paid to the investors, right? So whatsoever the recovery is being made, that will be paid to the investors out there. So investors will be earning money, and because they are taking the extraordinary risk, and also whatsoever the liquidity was there, the ARC will be keeping the margin of there, and further will be paying the rest of the amounts to the bank out there, that is the originator out there. So that is the case related to securitization. So this is a flow diagram of securitization. Is that clear? Kindly please do confirm. So securitization is actually a process where the financial securities, which are in the form of the SR, so these are actually what? These are the financial securities which are being issued by the ARC. So these securities will be issued. So these securities will be issued, against the cash flow generated from the pool of assets, and further cash flow arising from this particular assets will be issued, and further whatsoever the stream will be there, that will be paid to the originator out there. And this is how in this process originating bank is actually transferring the credit risk to the investors. Now whatsoever the credit risk which was associated with these NPA loans out there, that was actually transferred to these particular investors out there. That is the process of securitization. That is the process of securitization. Now the securitization can be of two types. It can be either of the particular types. Let's say it can be of traditional securitization, it can be a synthetic securitization. Now in that particular scenario, if we talk about the particular traditional securitization, the example I just gave you, it's actually the traditional securitization, right? But in case of synthetic securitization, there can be two different risk positions. There can be two different risk positions related to the different risk degrees, where the credit risk can be there and the whole part, and also it could be related to the unfunded credit risk can also be there, right? So it's quite complex there. So you just need to memorize one thing, that the securitization can be of two types. One, it's related to the traditional securitization, and the other one, it's related to the synthetic securitization. Is it clear? Is this particular part clear to you? Now after that, the next one we are going to cover is collateralized loan obligation. We are going to cover the collateralized loan obligation. Now let's come back to the whiteboard here, blackboard here. So it's actually related to the CLO. It's actually related to the CLO, that is collateralized loan obligation. Now, in the particular case of CLOs, it is actually securitization of the commercial loans. So now we are not talking about the, let's say here we are having an originator. We are having an originator. The same process, there will be pool of the loans, but in that scenario, the loan would be what? These will be the commercial loans. These would be the commercial loans, or we can say high risk portfolio is there, or we can simply say high risk portfolio is there. All right. Now there will be true sale of the assets. There will be true sale of the assets to the ARC, that is a asset reconstruction company, that will be setting up SPV, that is special purpose vehicle, and further the notes will be issued. The notes will be issued, or security receipts will be issued. But these security receipts which will be issued over there, these will be under the multiple tranches. It won't be like single kind of security receipts will be issued. It will be like, because these all were commercial loans and these all were rated, all different loans were rated, and we will be bifurcating, like some of the loans may be of the AAA category, that we will be saying it to be senior class. We will be saying it to be senior class. Based upon that senior class, security receipts will be issued, right? And the other one, it could be related to mezzanine. So when we say A rated, it's a mezzanine which is carrying much more higher risk, right? And further it could be related to double B, that's basically subcategory. And further it could also be the case related to non-rated or unrated particular security receipts or notes out there, right? So the different classes of the notes are to be issued. Different classes of the notes are to be issued in this particular scenario. Now in case of CLO, it's not the just case that you simply issue the security receipts, because you are having the exposure on the commercial loans, that is a high risk portfolio. You have already rated those particular different loans out there, and further we are going to issue the credit notes. We are going to issue the credit notes based upon the different ratings, based upon the different ratings out there. So that is actually related to CLO. And further, how the CLO is actually different from the credit linked notes. Now you say the same purpose was being there in case of the credit notes, then how the CLO is actually different from the CLN, that is a credit linked note out there. Credit linked note out there. Now in case of CLO, now in case of credit linked note, there was only single entity. If you remember, in case of the CLN, there was single entity based upon which the credit linked notes were issued. Single entity was there in case of CLN, credit linked notes, right? But in case of CLO, there is actually pool of the assets based upon which the credit linked obligations are being issued. Credit linked obligations are being issued. Is that clear? That's the first difference. And further, In case of CLO, there is true transfer of the ownership of the underlying asset, whereas there was no typical true transfer. There was no true transfer in case of the credit linked notes, but in case of the CLO, there is true transfer of the underlying asset out there. That is the main difference between the CLO and the CLM. Is that clear? Is this particular part clear to you? Kindly please do confirm at the earliest. Kindly do confirm over here at the earliest, right? So that will be actually related to the credit risk out there. That will be all about the credit risk. In the next video, we are going to start with the operational risk. So we will be covering the topics related to operational risk, what are the different types of it, and also integrated risk management. And also we are going to cover the particular case studies, a very important set of case studies that we are going to cover in the next two videos. So next two videos are going to be very much important, and let me just reiterate again that if you have not watched the part number 5, the video is still available on the YouTube channel, so you must considering it watching right now. You can find the link in the description below, and for if you want to get all the case study PDFs related to ABM, ABFM, BFM and BRBL, you should be WhatsApping us, writing CAIIB case study and WhatsApp it to the number 83609444207. And further, we'll be sharing 200 plus case study PDF links and video links with you guys so that you can be watching those case studies and further can be learning the most important concepts related to the same. So if you have been liking this particular series, give this video a thumbs up and further consider sharing it with your friends and colleagues who are preparing for CAIIB exam this year. Thank you so much and see you tomorrow at the same time in the morning.